What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. Today's panel discussion is focusing on the macro and technical analysis of the current market environment. Is the bear market over, or are the bears just taking a breather? What a perfect day for this show. My guests for today's panel are Andy Constan. Andy has 35 years of investing and trading experience. He spent the first part of his career at Salomon Brothers as the head of global equity derivatives. Andy also worked at Bridgewater as an idea generator and at Brevan Howard as chief strategist. Today, he is the author of Damp Spring Macro Research. You can check out Andy's work at dampspring.com. Next is Jimmy Jude. All of you know Jimmy. He's a fan favorite of the show. He was actually on with me last week. He's an ex-CME Group floor trader and currently an independent electronic trader focusing on trading futures and options. Today's podcast is sponsored by TradeStation and FTSE Russell. If you are a serious futures trader and you want a powerful platform to match your skills, enjoy flexibility and trading with TradeStation. They have an award-winning platform. I use it all the time. I use it for pretty much all of my trading. Learn more at tradestation.com/Anthony. Did you know with an 81% share and 1.6 trillion in institutional assets benchmark, the Russell 2000 is the top choice by far among institutional investors? FTSE Russell is the home of the Russell 2000 Index. To learn more about FTSE Russell and their products, please go to FTSERussell.com. Now, before I get Jimmy and Andy in here, I want to remind all of you that Futures Radio Show podcasts are recorded and posted on iTunes, Spotify, and everywhere, pretty much everywhere where you listen to podcasts. Throughout today's live discussion, subscribers to the channel can ask us questions in the chat. So please take a quick second and subscribe to the channel and hit that like button, and I look forward to chatting with you throughout today's show. Now let me bring in Andy and Jimmy. Hey guys, how
Hey,
are you?
Anthony. Hey, Anthony. How you doing, buddy?
Good, man. Jimmy, you and I 2 weeks in a row. Every week, look at you and I are definitely not the smartest guys in the room.
You know what? We're kind of probably your typical investor, or we ask a lot of questions, and hopefully we can find a common ground between some of these amazing market participants that we're having on the show, and some knowledge to be passed on to the viewers.
That's right, man. You and I, we love Andy's work. Andy, you have an amazing history of all the places you've worked, and I love the Damp Spring. I actually was just reading it this morning before we came on today, and actually I want to start off with something that you put in your latest report. You talked about markets are priced in for a soft landing, but you think they're wrong.
Yeah. Thinking something's wrong is really the odds of it occurring, not that it's impossible. Well, soft landing is possible, and it would look like a drop of inflation to target and a growth trajectory that would fall probably below the sort of trend growth, but not a lot, without job losses and things of that nature. And that's certainly what the Fed is trying to engineer. And so it's possible. The question is it priced? And my basic work says it's priced at around a 30% probability that we have a soft landing. And each day since the beginning of this month, more and more people have come on to that, and the probability has risen to this 30% level. And I think it's closer to 10.
So 30% is what you think the marketplace or other macro people are thinking that's where we are, but you actually think it's closer to 10.
Right. Yeah. And so the way you think about the probability of such a thing is that we sort of know the alternatives to a soft landing. One I've called higher for longer, which is inflation stays sticky, growth stays either strong or strongish, job gains stick, and so that generates high wages. And there's a scenario of that nature, and the Fed's going to have to tighten more than's priced, as one side of the coin. And I think that's a reasonable probability. And then the other is something that, I think most market participants expect, that are long-term market participants expect, which is the Fed will overdo it or has overdone it. And we're headed for a recession where growth will go negative and inflation will fall potentially below target. And each of those outcomes has a different, those two outcomes have a different impact on portfolios. The recession one's pretty straightforward. It's the last 40-year playbook. You buy bonds and you sell stocks into a recession. The inflation longer scenario, you really don't want to own bonds. And stocks will do okay. And so if you pencil out each of those things and then compare them to the sort of best case for bonds and stocks that a soft landing will generate, and then you look at the relative returns, you can pencil out, and this is what I do in a more complete way, but even if you just do it at home on, as a home gamer, you can pencil it out and see that the odds of that, that bullish scenario for assets overall, that is a soft landing, is around 30%.
I want to bring you in here, Jimmy, and we read Andy's stuff, and we look at the macro environment, not because I think you and I are trading really on that wide of a time frame. We're investing on that time frame, but as traders, it's so important. And you have been really drilling this in all the conversations you and I have had. You on Twitter for the past year and a half, you're like, the data and the macro has never been more important. I don't care what your time frame is. If you're not aware of it, you better get aware of it. And so this conversation of whether the markets are priced for something like a soft landing, explain to everybody why that's so important to traders like you and myself.
Well, I mean, the way I originally, I always like to look at the market in second and third derivative thinking. If you stay on the surface, it's usually when traders like us get hurt, because you can be thinking logically and have bad outcomes on trades because the market goes on a whim or whatever, So the overall, whether or not it's a soft landing or a hard landing is important to me. It's just because that's kind of how I want to set my sails every day. It's kind of like my default. What I'm thinking, with all that I'm seeing, I don't want to get caught this way, And I've actually I was a little bit in disagreement. I was kind of agnostic about it, but I was disagreeing with Andy a little bit earlier. But, the numbers I'm starting to see how difficult a soft landing is going to be, because these numbers are starting to deteriorate more rapidly. And the Fed, they haven't even really pivoted off raising. They still have to go from raising, say they go a quarter next time instead of a half. They're still raising, and then they have to communicate to the market that they're pausing. Then they have to communicate again to the market that they're easing. That takes time. And I don't know at this point if it seems like this situation could deteriorate a little faster than they're anticipating, and they're not going to have enough time to actually turn the ship around. And, so I'm starting, I see it. The only thing that I look at where I'm like, are we going to go on some wild ride to the upside and squeeze everyone out first, is because we're sitting on all this technical, it's such a super important area. We're on this big trend line. We're on, we're above all the EMAs. We're above the 200. And, I know that there's trend following systems out there that if we go a little bit further higher and we settle up there, it's going to flip them. They have lines of code in there where staying above the 200-day is a big deal, so you're going to get these just pure technical participants come into the market. But then again, we were talking to Jem last week about the option scenarios out there too. And the options is kind of a tinderbox right now because the wings have become so cheap. They've taken the skew out of the market. So if you get, if we do settle above here and we do go on some technical rip up to 4,100, 4,200, whatever, that doesn't take hard landing off the table. That's a technical move. And in reality, a lot of the stuff that's adding to, the potential for hard landing will probably be augmented because it'll embolden people to add to it, So it's an amazing time right now, and it's super fluid. I can't tell you exactly when anything is going to happen. It's literally like an economic data point by data point at this point, for me anyways.
Yeah, I agree with you, and I want to go to Andy on this. A couple of things. Number one is I want to just talk a little bit about what Jimmy had said on the move higher. I agree. I'm more of a technical based trader because I'm just really more of a short term trader. But the one thing that I've learned as a technical trader is technical traders will get me in, but macro will keep me in, right? And it goes back to what Jimmy said, that if you don't know the macro environment, like right now I'm long a bunch of stocks. I actually bought some puts today, and I was talking about that. I'm trying to manage my own portfolio as well, not only just what I'm doing intraday. And it's hard to stay with a long position, I think, in this environment because of all the things you talk about, Andy. But I want to go to something that you did mention, and it is the Fed. People are thinking that the Fed maybe has overdone it. I know you believe that we're looking at higher for longer. Do you believe the Fed will over-raise? Do you think they've already over-raised?
Yeah, so I want to clarify that. What I'm looking for is not a soft landing. I'm not looking for higher for longer. I think that's an outcome. And I'm not looking for a recession. I think that's an outcome. I'm looking for one or the other of those things, but not the soft landing. And I think that's really important because if I was looking for a recession, I'd be long bonds and short stocks. If I was looking for higher for longer, I'd be long stocks and short bonds. And the only time both of those assets are going to rally is in a soft landing. And that's how I lose, because I'm short both bonds and stocks. So the idea here is that without a doubt, the data has been deteriorating, and that has made the soft landing case more palatable, and the potential for the Fed to, we're now we're now priced to have a terminal rate well below anything that the Fed has penciled out. So there's already pricing that says, the Fed is going to stop hiking. But what I'd like to say is that I think markets are actually, and this is why I think short on both is a better trade. I think markets are already are both way ahead in certain cases and also ignoring in other markets. So, for instance, Jimmy talked about this idea of overdoing it, and if they have, they're going to have to cut. And so the question is how much and what's already priced. It's not, hey, the market is allowing us to make that bet free. The market is charging 210 basis points to make the bet that there's going to be cuts in the next 18 months after June. So already the bond market is pricing 210 basis points of cuts in June, from June to DC24, which is, using SOFR futures as a proxy for that. Depending on what you're using, you're going to have basis, all that. But by and large, they're pricing a lot of cuts very soon. And that happens not in a soft landing. That happens in a recession. And to me, so I've looked at historical cuts from peak as a recession happens, and 200 basis points is about 65% of the way to what the typical cut is. So that's saying the bond market, the short-term bond market, has a 65% odds that they're going to do a 300 basis point cut, which says, that's a big number. That is way ahead of any soft landing. That's a deep recession response, and that's already priced. So I look at that, and then I say equities, they aren't priced for a deep recession. They're priced for $225 EPS and roughly an 18 PE. And the reason why they're up is because there's an expectation that these cuts will happen before the pain, and that'll support the multiple, and the earnings won't actually fall. So the bond market's over here with recession pricing. Not all the way. Obviously, there are 300 basis points of cuts. That would have been once the recession happened, but a long, long way toward recession pricing, and the equity market isn't. And so to me, that's an interesting dynamic in terms of how one positions themselves given the various odds.
You know, it's funny as traders, I hear so many people say the markets are so efficient, everything is priced so accurately, right? You hear that a lot. People say that. The price is what the price is, right? But when you look at these types of things of what's happening, there's so much opportunity out here for these different potential outcomes, right? And I think this makes it so difficult as an investor and as a trader because I just think it puts a lot of weak hands out there, and I think it's what's going to continue to cause volatility, right? Kind of feeds into your world, Jimmy, where you talk about, what are the options markets doing? And one of the things that we talked about, and maybe we pick Andy's brain about this a little bit, is that, last week we talked about the options market and how the options market has now really is not as protected, or I don't know, maybe you explain better words than I can. The options market is not anticipating the type of sell-off or volatility that it did at the beginning of last year. It's now really gone away from that, which in turn, ultimately, maybe that's what creates the volatility and capitulation. Have you seen anything change maybe over the last week or so as you've seen some of this data come in the options market?
It's been a long, slow slog for like the skew of the options market. So this has been an ongoing theme this entire year. People have, traditionally to protect yourself, you go out and you buy cheap wings or cheap downside puts, and they got destroyed this year, absolutely destroyed. So people, and it's just human nature, you just abandon, people just start abandoning what's not working, and then they jumped on like the gamma rich at the money type of short dated, options to try to hedge off. But, obviously you can't hedge big risk with that type of option play. So, now you have like, that's what we were talking about when, like now, like a lot of these downside hedges are gone. These guys have just abandoned them because they haven't worked. And on top of that, if you go a couple derivatives past what they normally buy, Jem was saying that there's a lot of guys short that stuff out there. And he said, so that's how the options usually, they create this like scenario where, something doesn't work, people start losing money, they abandon it, they go to another thing, and it's always a little bit more risky, and that's the thing that causes the rubber band to stretch and snap, and then it filters on into other markets. So yeah, and that's what they, you read some articles and they tell you how hedged up everyone is, and everyone's negative and this and that, but in reality, options skew in equities does not say that in the least right now.
Perhaps I can give some perspective on that, Anthony.
Yeah.
As you know, I ran the global equity derivatives business at Salomon Brothers for 17 years, have always traded equity derivatives throughout my life. It's not what I do right now. And guys like Jem are, the experts at it, Spot Gamma, others. What this situation reminds me of is when I started my career, I was Salomon Brothers representative on the Brady Commission. And that was the presidential commission that investigated what happened when the stock market crashed in 1987. And I had the good fortune of being one of 5 people who figured it out. And it wasn't hard. The footprints were everywhere, and we had the data to back it up, was that portfolio insurance was the root cause of the extreme move in the equity market on those days around the crash, including the crash. What's interesting is that index options had only started 5 or 6 years before, and they were very rich as perceived by the inventors of portfolio insurance. And so portfolio insurance just says, don't buy expensive wings, dynamically hedge as if you were recreating a put. And what that means is, just like a dealer, when they're short puts to a hedger, they have to sell on the way down and buy on the way up. And hopefully their losses in that activity are more than compensated by the implied volatility they receive from the hedger. Now, why I bring that up is, as Jimmy said, and I think this is well known, those who used options to hedge during this period of time, long-term options to hedge, short-term gamma worked fine, but the real institutions that buy puts, 1-year puts, or even 6 months puts to hedge their portfolio were very disappointed in the drawdown as both market prices fell and implieds fell. And so what I've seen in the last year is a significant move by institutional investors toward traditional portfolio insurance, reducing the demand for the wings because they are manufacturing the wings themselves through their activity. And so I think you're going to see that continue. And that has implications as markets move. Falls tend to be in such a circumstance as all of these players start to move to the door at the same time in both directions. Markets can have relatively high realized volatility if there is an event that drives markets. So I agree. I think the demand for options from institutions, buy-side options, is low, but I think the gamma is still there.
Yeah.
Yeah, Jimmy, touch base a little bit on that because I think that's such an important part of this conversation. Next, that's what we're looking at. What can determine next is understanding how the market's currently positioned. Talk a little bit more about that. I don't think people fully understand that with the gamma.
I think like the scenario that'll bring this to a head would be the scenario like if we started, what if we hung out at 4,000 longer than, people had anticipated? Everyone's thinking we're, including myself, we're about to rip either up or fail and rip down. But what if we just hung out here for a little bit and all of a sudden, you've got a position on where you're like, what they traditionally call long the meat, short the wings, something like that. And, now the wings start coming up on you. Realized vol gets smoked. Implied starts getting bid, and there's no hedging for it. And there's no hedge for vol but vol. I think Kem said that last week. And and when there's no inventory, there's no inventory, and that's So then you're like in a situation where the outright's not even really moving, and all of a sudden, the underbelly of the market is really starts getting ugly, and then you have a big washout.
I actually want to go through a timeline from here going forward. Actually, I'm seeing this question come into chat, and everybody, I should just say, while we take a quick moment here, please put your comments and questions in chat. We want to hear from you. I'm seeing some of the questions come in, and I know it can sometimes get quiet when you're listening to two really smart guys like this on talking about the market, but we want to hear what your thoughts are because it helps feed into the discussion.
I have a question for Andy.
Let's fire it up.
He's like, he's really like one of the top guys of the plumbing of the debt markets. So he's really good with QT, and I know you've been explaining it on Twitter and sharing a lot of free knowledge, which is amazing. But you've touched on, and I just wanted to talk about a little bit. You touched on the TGA, which I believe you described as kind of like the checking book or the checking account of the government, and then you said. And you were talking about issuance and cycles of building the TGA up, and when we draw it down, as we're doing QT right now, what are those effects? Because that's going on in addition to all this, everything that we're talking about, and that's having an effect on the market. Where are we in that cycle, and how is that affecting us over the next like 3 to 6 months?
Yeah, so I think that the most important thing that we now have to do is put in context all of the flows around QT and the issuance and payments of monies through the Treasury um, in the context of the looming debt ceiling. And I think this is broadly misunderstood. And so let me touch on the debt ceiling, and then we'll get to the reaction that each of these accounts will have. And let me be clear, understanding the size of the Fed's balance sheet, understanding when and how the Treasury issues building their checking account, and how they spend drawing down their checking account, and also how savers that are currently accessing the RRP change their behavior through time is part of a very useful idea about flows into long-term assets. You need all that information. You can't just give it up. I don't think you can just have just that. There's a very popular formula out there that people depend on that I think is inadequate, but it's also good. It's not something that you shouldn't have. It's something you need, plus other things. So in the context of the debt ceiling, let's start with the first thing. There's a broad misunderstanding of what extraordinary measures mean. And what extraordinary measures mean is and this is all available on the Treasury's website, they can essentially, with the snap of a fingers, I guess, reduce the amount of debt subject to the ceiling. And they can do that by canceling something called the G Fund. The G Fund is $325 billion. Look it up. It can be canceled legally, authorized by the Congress, and that allows them to issue $325 billion of more debt. So even though we're about 70 billion shy of the ceiling right now, and you'd think, well, that means no government bonds are going to be issued, that's just wrong. Over the next 6 months, before the crisis occurs, the government has, let's call it $600 billion of deficit spending, meaning they need $600 billion of money. The TGA, which is their checking account, has 350 in it, and they've got 400 billion of capacity to issue because they use this thing called extraordinary measures. That leaves quite a bit of flexibility, and that's the reason why Janet Yellen has, broadly said, this is a late second quarter, June, July issue, because they can run the government on tax receipts, net of spending, and issuance within this $400 billion window and the TGA. So does anyone have any questions on that first? Because I think there's a broad misunderstanding with certain investors about how many government bonds are going to be sold over the course of the next few months. If, for instance, they were to cancel government bonds, that would have a huge implication for the Treasury curve, because that lack of supply needs to be bought by people, and that would rally bonds a lot. So if you're long bonds thinking there's not going to be supply, I think you're making a mistake.
Okay.
Yeah, Jimmy, follow up with that. This is not something that I personally follow too much. Like you talked about the plumbing and all that, about what's going on. I found that to be very interesting. It's to be honest with you, Andy, it's not something that I have followed in the past, and maybe some people out there in the audience want to chime in. I'm the first to admit this is not something I'm totally aware of, but it is very interesting to understand like how this does impact things. I mean, I think there's, we get so caught up in just looking at some of these basic things that we hear happening on headlines or, or the media. That's something I have not really heard many people talk about, even in a lot of macro discussions.
Yeah, I think it is being talked about among some. It is a fairly arcane issue, but we were talking about the Fed's balance sheet. We were talking about and there's quite a bit of people that are saying the Fed is injecting a ton of liquidity by spending the TGA, and that's by and large true. They're not if they were not issuing to consume that liquidity. And that's the presumption that people are making, that the debt ceiling will prevent issuance and the TGA spend will hand money to investors. And that combination of things is bullish for assets. But the premise assumes that the debt ceiling caps issuance. And the answer is that if you understand the extraordinary measures, that's just not true.
Where are we in the cycle of the TG? Are we in a build at this point, or are we?
We're in a spend. We're in a spend, and
we've turned it. Okay.
Right. That is handing money to the economy that was financed in the past. Right. Mm-hmm. You build a checking account because you either have gotten taxes or you've issued in the past, and your checking account gets bigger. Yeah. When you're spending it, you're giving it to the economy, and that provides money to the economy.
And right. So is that supportive of equities?
It's supportive of assets in general.
Assets in general.
Right. Yeah. Because, when money is handed to people, I don't want to drift off of this. This is real macro, though, so I'll give it a shot. When money's handed to people, you have to look at who gets it. Our spending is about 80% of our spending is handed to Medicare, to Social Security beneficiaries, to job security beneficiaries, and to the military. And those are the primary expenditures. And when they get it, they're not buying spoons. Right? So there's a loose connection between them getting the money and people buying spoons. Ultimately, they spend that money on goods and services, and that becomes somebody else's wages who saves a little bit of it. And some of it becomes corporate profits, and those guys save it, but they're not buying spoons either. Yeah. Those guys are buying either a diversified basket or putting it in money market funds. And that's not supportive of assets. So it's very important to understand that when a TGA gets spent down, it doesn't go into SPOOs. It goes into SPOOs a year from now or a year and a half from now, because at that point, it's all savings and people diversify. They own some bonds, they own some SPOOs, they own some international stocks, et cetera. And so the money handed to the economy does support assets, but you have to understand how it flows through. And so that's something I track, and don't think that the current TGA spend down is particularly supportive of SPOOs. We've had a big rally in the last 12 days or so, 12 trading days. There's a lot of people pointing toward the TGA as being the root cause of that. And I think it's mostly just animal spirits as people decide that a soft landing is more likely, and that causes regular old investors to deploy cash or lever up and deploy cash. And I think that's what's happening.
For those of you that don't know what SPOOs are, you're talking to a couple of old school guys here. That's the S&P. It's been years since I've heard somebody talk about it in that way.
That's all I ever called them.
It's the Solomon brothers in you. It's. I remember how many times we would hear those orders come in through the pit for saying it was Solomon. I can't remember what their symbol was though, Jimmy. It'll come to me in a minute. I remember Merrill, Goldman,
Plaza.
Huh?
Plaza was our badge.
I have a question about what happened last night. Could you explain to us what happened in Japan and what did they ultimately decide to do? Because it's pretty confusing between yield curve control and more QE. And I know you can set us straight on this? I know you have the answer.
That was on my list, Jimmy. So it's a great. I love that question because I
So by
don't
and
know.
large, nothing
They
happened.
didn't do it. They didn't change
They didn't
policy.
change their policy. Their policy is still to target 0% for the 10-year note.
Mhm.
And the important thing about that isn't the 0%, it's the width of the band that they allow it to trade within. And that was 50 basis points prior to the meeting, and it's 50 basis points today. And I would suspect that the rally in bonds, certainly in the United States and the globe on the open, was related to that because there was a concern that they would expand the band to 1% or perhaps eliminate the band. Those were low odds, but that was speculated. And it all comes in context of a Kuroda administration, who is currently the Jay Powell equivalent in Japan of the BOJ. His term ends in April, and he has this meeting and one other meeting before his final meeting. And so there was some thought that he would hand his successor yield curve control having been canceled. And if so, that would have had a fairly meaningful impact on the global bond market, as better yields were then available for Japanese investors. And Japanese investors are the largest single international investor class. And some of the money would get repatriated, strengthening the yen and weakening the US and global fixed income market. And that didn't happen. And so now the question is, will it happen?
Yeah. Does Japan have the same type of inflation issues that the US and Europe is dealing with?
Yeah. So my outlook on Japan is that their economy needs stimulus, and that I've never been one who thought that they would actually begin tightening. I was surprised when they widened the band to 50 basis points. So I don't think they have the inflationary problem we have. They have a extremely aged population. They have a declining population, and they have a deflationary culture that has really not sort of embraced inflation the way the West has. And so, no, I don't think they have an inflation problem. In fact, for their economy to achieve potential and frankly provide the young of Japan with a future, I think they need to weaken the yen significantly and stimulate. And so, but that's a longer term view. Shorter term, they certainly don't have an inflation problem.
Okay.
I want to talk about a couple of things here. First of all, everybody, just a quick break. Remember, this podcast is brought to you by TradeStation and FTSE Russell. Learn more about FTSE Russell by going to FTSERussell.com. And of course, go to TradeStation.com/Anthony. They've got some great deals going on right now over there with commissions if you're a futures trader, and the platform's fantastic. It's what I use, like I mentioned, for most of my futures and stock trading. We're going to be getting into some of your questions next here, so please put them into the chat. One of the things I want to get to, there's actually a couple of things I want to get to before we get to questions. Number one is, and it's a question that Jeff actually put out there, and so I'll just put Jeff's up here because it's the same question I was really going to have. You talk about long bonds and short stocks. Let's talk about your current positioning a little bit. I know you have a little different feel or you have some different positioning on what you think from the U.S. side of things versus Europe. So maybe we go over that when you talk about what your current positioning are with long bonds, short stocks, U.S. and Europe.
Sure. So I currently have a view on the globe that I've written. I have positions on in the U.S. I have small, long Chinese equities, which I put on recently. But my international positions are small at the moment because I think there's enough opportunity in the U.S., but I will give you that overview. Firstly, just to Jeff's question, I mentioned being short assets. I consider assets to be long-term assets. And so in expressing a short asset view, I'm short the long-term bonds. TLT is an example, but you can use bond futures or whatever. At the same time, I have a very, I think the 210 basis points of cuts expected in 2023, the last half of 2023 and into 2024 is extreme. And so there are trades to do that use use Eurodollar futures or that ilk of thing to take that view. And I have that position on as well.
And so talk to us a little bit about Europe, because in Europe, I know you've talked about the long stocks as short bonds, so it's a little bit different than what your U.S. outlook is.
Yeah. So in my sort of my 2023 outlook, which I wrote on November 15th, which is available on my website in the archive section. I started at the in the East and looked at the conditions in the East relative to the rest of the globe, which started out with China at some point is going to need to stimulate in the context similar to the way we did in 2021 as they come out of lockdown. Japan, as I said, still has a weak economy and needs to stimulate. And what that tends, and then moved around the globe. The next stop was Europe, where Europe has their economic conditions, absent the supply issue associated with the war, are more like 2022, January 2022 in the US, and then come around to where we are. And I looked at that in two dimensions. One is cash trash or is cash king? And an environment like mid 2021, assets were great and cash was trash. And so that to me is the way I'd position myself in the East. But as you come around the globe, Europe is in a position where it is beginning its tightening cycle, and cash is becoming more attractive. Is it attractive enough to say, sell all my assets? It's cuspy. In the US, cash is king. As I've said, I don't like assets because I think further tightening is going to happen. Now, that also provides you a dimension of whether stocks outperform bonds or bonds outperform stocks. And the climate in Japan and in China is very attractive to stocks because there's going to be stimulus and there's going to be growth and there's going to be an attempt to generate inflation in Japan and a growth injection in China. And so I much prefer stocks to bonds in the East. When you come around to Europe, there's a lot of tightening that has to happen. And as you saw in 2022, there was a period of time where, and still is, bonds have massively underperformed stocks while both went down. So cash was king in the US. I imagine cash will be king and assets will be trash in Europe, but stocks should outperform. And then when you come back here, cash is king again. And I think bonds should outperform because inflation will only be killed whether it starts high and comes down or crash lands one way or the other. Cash will outperform assets and bonds will outperform stocks. So that's my outlook.
So I want to pull in I want to talk a little commodities right now too, because I'm actually short a little bit of gold today, long a little bit of crude oil, long stocks. I'm just trying to play the waves here a little bit, Andy and Jimmy. But gold to me this year, I think when you look at this chart, it looks very bullish. It looks the most bullish I think in some time, really going back to the beginning of last year. And the question is, and I'll go to both of you guys, do you think gold is just kind of playing off of what it did last year, coming in hot and then fizzling out again? Or is gold actually now a solid play? What do you think, Jimmy? Maybe we'll start with you. We'll go to Andy.
Gold has just been one giant torture chamber for me my entire career. So, what I say now is probably the greatest fade of the year. But, I think as like gold is coming up here to be sold again. Like I don't think it's going on some crazy run. I really don't. I would be a seller in here, but buyer beware. I am not a gold bug. I'm not. Yeah.
So I feel the same way. That's like even like today, I looked at it and I said, why I didn't mess with trading the futures tie of S&P or Nasdaq today, because it's like I want to be a little bit bullish, but I'm like also like it's already how much we've rallied in January 18th. I'm kind of looking at that, and I said gold to me, finally had a lower high and a lower low. I stepped in and got a little short, but that's just a day trader mentality. Andy, for you, we're looking at the macro. I mean, how many people have talked about, I would say over the last year or so, bullish gold. I mean, well, the gold bugs are always bullish, but then you got a lot of people always, you hear the macro guys just pounding oil too, right? There isn't a podcast or a person I don't follow that's not bullish gold and oil right now, more oil, but we'll start with gold and then maybe we'll flip to oil with you.
Yeah. So I worked at Bridgewater and for a long time, and you work there for long. And well, even if you work there for a few days, you start understanding the attraction of gold as a diversifier in a portfolio. And I strongly believe in gold as a diversifier. Own gold in my beta portfolio, will always own a greater than what most market participants own in gold, for balance reasons, and for potential tail risk of central banks that don't end up that give up on inflation. I think your last guest probably talked about the idea that inflation could last for 10 years, and the Fed may give up to the 2% target. You got to own some gold in case that happens. I don't think it will, but it's a great diversifier. And yesterday I sold call spreads on gold.
So, here's my question for you, Andy, before we move on to oil is like, and I got the gold chart up. I do my own investing, a portion of it, right? And I remember I was long a bunch of stocks in my career back in 2008, and everyone's like, you know what, buy gold, it's a hedge against central banks, right? One of my mentors, Ira Harris, always a lot of people talk about that, right? I remember buying gold and just getting completely worked over, and it really didn't hedge against my portfolio. You at Bridgewater, I guess for the people out there, understand, how does it actually work? Is it because look at even today, gold is staying bid all morning. The minute equities get cracked, it seems like it pulls them right down. And that's not always the case, but I don't know. For me, I'm trying to understand how you guys look at it as an actual something you want to have in a portfolio as protection or a hedge or whatever.
Sure. I wrote a 101 that's available at Damp Spring on Twitter, and I'll repost it later. But the basic framework is that gold is an asset, and gold responds to certain things in certain ways. And if you can predict those things, you can have a sense of where gold is going or why it's gone where it's had. It's easier to attribute than predict. And the simple answer is gold is a currency that pays no interest. And so when currencies are paying real interest, that is higher than gold, that's rising relative to gold should fall. And so higher real interest rates are bearish gold. And that's just simply because you can hold your money in an interest-bearing currency, or you can hold your money in gold. There is a small bit of growth because it turns out people want more gold when they, for jewelry and for consumption, when growth is strong. So there's a small delta to growth. Let's ignore that for the time being. Then there's the monetary aspect of gold, which is when more dollars are created, for whatever reason, the quantity of gold stays the same and the amount of dollars that can buy them increases, and so the price increases. So there's this idea of monetary, but remember, everyone expects monetary expansion. So it has to be an unexpected expansion of the monetary base, not the normal expansion expansion to drive gold higher. And then there's the tail. And this is not the gold bug tail where we all end up, guns and gold is what you need to survive in the dystopian world we'll end up living in. But just simply a matter of central bank credibility that they will do what it takes to avoid monetary fiat devaluation. And most gold bugs and many investors are fairly suspicious about the credibility of the central bank. And so set your own level of credibility and then observe whether the credibility is strengthening relative to your baseline or weakening. And when it's strengthening, gold's going to go down. And so I think those are the principal drivers: this tail risk, this monetary, this creation of money risk, and then the simple fact that gold is a currency that doesn't earn interest.
Yeah, no, that's a great explanation of it, and I appreciate you doing that. Let's move on because we're starting to get some questions, and I want to go to crude oil. I'm curious what both of you think. Last time we started with Jimmy. This time we'll start with you, Andy. Crude oil, it's taken a little bit of hit as we've seen equities pull back. It's still up on the day. It's gone on a massive run off the lows. Like I mentioned, everybody I know on the macro side of things is bullish. What are your thoughts about crude oil?
I don't have a strong opinion. Again, I believe probably more so than others because of my training that a 60-40 portfolio needs commodity exposure to be balanced. And so I believe in owning commodities as a core long-term investment. But as a speculative investment, I happen to be long some out-of-the-money calls in December of 2023 on December futures. And that's simply just a play that when the SPR starts rebuilding, that'll create enough demand to offset the potential recessionary demand drop and cause oil to creep higher. Otherwise, spot oil, there's the supply and storage and all those sort of things. Generally not something I play.
Jimmy, let's go to you. I
I'm
know that
on.
you're always watching oil. What are your thoughts
Yeah,
on it?
I traded oil for a while, but I'm long oil right now. I originally it was, it came down to that area where, the U.S. government said they were going to start purchasing it back into SPR, around 70. So I figured there was some type of natural floor in that area. Anyways, technically, it seemed like a decent point on the charts. I know, okay, so the economy is slowing. There's other issues out there too. I don't think the Russia-Ukraine situation is going away anytime soon, and chances are that could escalate. Especially in the spring. All sorts of things can happen from here. I have zero confidence in this administration to hold the price of crude down. So I'm long it.
Yeah, I'm kind of in the same boat as you. I'm long it as well right now. Watching this break right now is kind of painful, but as I actually bought some daily options on them today earlier too. So it's just anyway.
It's one of the, like, I started talking to Andy about a year ago because I was looking for older guys that had maybe had a little experience in an inflationary environment where I didn't. I started in '94, so you can kind of you know what I've seen.
Yeah.
And I know you were active in the '80s. You saw the tail end of a lot of
I wouldn't.
bond action.
'86, hard to say I lived through that.
Right, but you
I was alive.
Right. Between you and Nick, I've got some really great guidance. But one of the things that you said to me this year, and it was like such a lesson, and I'll always remember it. It was right after Powell's speech, and I tweeted out that like I hated the speech, that he was an asshole or whatever, something, and most of the reason I just got thumped in the market because I figured he was going to be heavy-handed and everything, but I didn't realize he was going to come out and just 2 minutes and just murder everyone. And you were like, no, that speech was perfect. And I'm like, what do you, this is the same asshole that was printing into March. I was so frustrated that, like, how could this guy go from so clueless one way to being and you're like, no, he has to set inflation expectations right now or else there's going to be trouble. And then shortly thereafter, we saw over in England, they did the opposite, and you saw them almost lose control of the gilts and market. All sorts of things, bad things almost happened. And I remember thinking like, oh my gosh, this is what Andy's talking about. Like, you have to expect that moment when you see these inflation expectations starting to run away. You've got to expect the hammer, so they don't lose control of the long end, and then things get really weird, and that was like, I didn't have that experience at that. I wasn't ready for the hammer, but that was a terrific lesson I learned that I'll bring forward, because I'm sure, it's not, I don't think it's going to be like, I think it's going to be like the 90s. I think inflation is going to be like this, in the coming years. So we're going to be constantly revisiting these macro issues.
Yep.
With only a few minutes left, I'm just looking at some of the questions, and they're great. And some of these people are always in here, so I always want to get to their questions. So as we wrap up in just a few minutes, I want to bring in Jim Valentine's question. Jim, always appreciate you coming in. Been a subscriber for a long time. Anthony would like to ask Andy how the major banks and large institutions are positioned after the pandemic and this era of inflation. Thank you.
Yeah. So let's start with banks, because I think that's more easy and you can just look at the facts. And the other thing is more of a concept. Over the last year, banks have sold a significant portion of their treasury bonds. And that's just simple math. You can just look at the data and it shows they've been selling bonds. What that doesn't show is their interest rate swaps positions. And there's a lot of people out there that are suggesting that, gosh, banks are really in trouble because they've bought a bunch of bonds at much higher prices. And on a mark-to-market basis, they have negative equity. And that ignores the fact that they manage their interest rate exposure. And by doing so, they can take a view. They don't have to take a view on inflation or on interest rates. They can hedge and just collect the difference between the cost of their borrowing and the cost of what they receive from lending, the NIM. But the important point here is that all of these banks report their duration exposure. And, Jamie Dimon has been very explicit on his view on interest rates. And not surprisingly, he's short bonds as an institution. So if you buy JP Morgan, even though they're long bonds, their hedge makes them short. They are more short. Their hedge is bigger than their long. And so that's how banks broadly have been positioned through this time. And so you've seen actually fairly decent earnings, and the flow through of the hedges has made their book equity stay high. But the rest of the set of institutions out there, that's a different idea. By and large, retail, meaning brokerage accounts, have stayed invested. Institutions, and I mentioned the portfolio insurance idea, have significantly delevered multiple times and then relevered like they're doing now. And so they've been, by and large, chasing price, which is what a portfolio insurer does. And right now they're pretty full of equities, at least.
Wow, that's totally, I did not understand that about the JP Morgan thing. I don't know if you did, Jimmy. That was pretty interesting.
Absolutely.
Last question for the day, and this is from George Hart. George is also a regular in the live streams. Appreciate you, George. Is it a situation now where keeping Treasury solvent and interest on national debt affordable rather than just battling inflation per se is actually objective number one for the Fed? We'll let both of you chime in on this, and then we'll wrap for today.
So my answer is the Fed doesn't care about the affordability of the debt. That's not their job. That's not their mandate. And it's a conspiracy theory to think that they're doing anything about that to manage the economy in the way they're doing. And more importantly, the a doubling of interest rates for an extended period of time would not put our debt service costs at a historically high level relative to GDP. And so at some level, it's a tempest in a teacup sort of discussion. But I have a strong view.
Jimmy?
I do believe there's a political aspect here between Powell, Yellen, and this administration. I know there's not supposed to be, but I don't see how you couldn't have some sort of quiet alignment. Where in other situations like this, the Fed was completely autonomous. I have a feeling there's kind of a there's more cahoots. I think they'd be easier on this administration, and that's also that viewpoint has gotten me killed throughout the year, thinking like they're going to back off, they're going to play nice here, but and why I brought up the inflation expectations story is because then I knew they're not going to do that. They're not saying anything nice. They're not, until it goes away, So, but I do believe there's a political aspect. And I just mean that they like each other. They're, you know what I mean? And sometimes that's enough, right?
Sure. I think one thing that you have to say is right now it's unclear to me what the politics are, given that the election has happened and we're almost a year, I think over a year from the first primary. So I don't see the political pressure yet, but I see where it could be. And certainly the pressure from the administration is going to be high, as it always is during elections. Whether they respond to it, that's another matter.
Yeah.
All right, guys, everybody, thank you so much for the questions today. Remember, follow Andy at dampspring.com. Also, Dampspring for Twitter, right, Andy?
Yep.
Highly recommend.
And he's got a new venture, Two Graybeards, which is investment advice, which is actually really great investment advice for people that don't have a lot of time but have a lot of money, and it's terrific. I've watched the videos this weekend. You guys are doing great work.
Thanks. Nick Giovannik, who's also on Twitter, and I started this thing. And our goal isn't to provide direct investment advice, but give you the right answers, the right questions to ask for your own financial advisor, so you can have better conversations and understand what's being done with your money.
Yeah, in a very succinct 20-minute chat every week, which is nice. It's great.
That's
product.
Awesome. Yeah, no,
Yeah.
I have not seen that yet or checked it out, but I definitely will. And Andy, it was great to be able to meet you today. I really appreciate your time, your knowledge. Everybody's putting in the chat is really incredible, and we thank you so much for sharing it with us. Jimmy, you're my brother. I love you, buddy. And
thanks for having me.
Thanks for coming on for
Appreciate
2 weeks
it.
in a row with me. I know.
You got it, buddy. Anytime.
Yeah, it was just a lot of fun, and I appreciate it. And of course, you guys know Jimmy on Twitter, so follow him as well. Andy, Jimmy, thank you guys so much. Everybody out there, thank you so much for tuning in. If you enjoyed the show, please share the show with your friends. Get more exposure for Jimmy and Andy. And if you like the show, give us the thumbs up. And that does it for this week. I will see you guys next week on the Futures Radio Show podcast. Cheers, everybody.
Cheers.
Thanks.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.